Alright everyone, the Berkshire Hathaway 2021 Shareholder Letter is out, and here are the most valuable pieces of information that I got from the letter. As always, Warren Buffett wrote a phenomenal letter. I mean, it's so easy to read, I cannot recommend it enough. So the video is going to be broken down in 3 sections, and at the end of every section there's going to be a takeaway from Warren Buffett's writings that we can use and implement in our investment philosophy and our investment process. Also, feel free to comment your takeaways down below, and maybe we can compile a better and more comprehensive list. Alright, no time wasted, here's the format. In part 1, we're going to talk about the upgraded Buffett investment strategy. In part 2, we're going to talk about the share buybacks principles. And in part 3, we're going to touch a little bit on bonds. In the first part of the letter, Warren Buffett outlines 2 different investing strategies. One is buying controlling portions in wonderful companies with good management and good economic characteristics. But in his view, this strategy requires a lot of work and headache with managing the business itself, as it was the case with the Berkshire textile operation. Influenced by Charlie Munger and having a sour experience with the Berkshire textile operation, Buffett lays out a better strategy. In his view, owning a non-controlling portion of a wonderful business is more profitable, more enjoyable, and far less work than struggling with 100% of a marginal enterprise. The point that Warren Buffett is trying to make with the second investing strategy is that in the long run is probably going to be more profitable. I mean, he says that it's going to be more profitable and it's going to require less or no work on the investor's part. I mean, he put it very nicely, like basically saying that in investing you don't get any extra brownie points for the degree of difficulty of managing your investments. As long as you are very profitable, you are generating a decent return on your investment, there's no point in getting an extra or by adding an extra degree of difficulty to what you are already doing. Then Warren Buffett goes on to outline again the core principles of a wonderful business, being a core competitive strength, aka the moat, management that is acting with integrity and talent, and finally he touches on the price, which is always a very important characteristic because it gives us the margin of safety. Here's the takeaway for me. All I have to do is to focus on finding wonderful companies with strong moats, good management, and then buy them at a reasonable price. That should be difficult enough in and of itself, so why complicate things? Why add a degree of difficulty to it? That should be enough to produce good returns in the future. I mean, as Buffett puts it in the letter, all that's required to produce wealth, lots of it, is the passage of time, an inner calm, and a minimization of transactions and fees. He also urges us to remember that we must never forget that our expenses are Wall Street's income. And unlike his monkey, Wall Streeters don't work for peanuts. I mean, we have to give it to him. That was funny. But in a way, this all ties back to the GameStop saga where actually Wall Street made a ton more money at the expense of the small guys. The clearing houses and the big hedge funds made a killing in the GameStop short squeeze as opposed to what media actually portrayed. Moving on to share buybacks. Last year, Buffett was on a buying spree of Berkshire stock, buying as much as $25 billion. Here is the quote from the letter on buybacks that will outline his thinking and behavior. In no way do you think that Berkshire shares should be repurchased at simply any price. I emphasize that point because American CEOs have an embarrassing record of devoting more company funds to repurchases when prices have risen than when they have tanked. Our approach is exactly the reverse. From this quote and from Buffett's philosophy on share buybacks, that shares should be bought back when they are trading at a discount to increase shareholder value, I see no other reason why he would buy a whopping 5% of Berkshire stock other than the fact that he believes that Berkshire Hathaway stock is currently trading below fair value. I mean, this could be a sign from Warren Buffett itself that Berkshire stock is a buy now. In the letter, Buffett also outlines the power of share repurchases by giving the example of Apple. Since 2018, Apple bought back a ton of their shares. As a result, even after Berkshire sold 6% of its Apple position in 2020, the total amount owned by Berkshire in Apple increased from 5.2% to 5.4% by pocketing $11 billion from the sale of its 6% position and by also getting an annual dividend of around $700 million. So even though they sold some of the shares, because of the buybacks, they actually own more of Apple now than they did before. So their actual ownership of Apple went from 5.2% to 5.4% with no additional cost, actually by pocketing a ton of money in the process. So as a takeaway, share buybacks can be a really powerful tool to increase shareholder value whenever it's done right. And actually, Monish Pabrai calls these companies that are aggressively buying back their shares cannibals because they are continuously eating themselves up. They are reducing the number of shares outstanding and therefore increasing the amount that the shareholders own of that company. And the takeaway is that those companies actually do very, very well over the long term. As a final note on buybacks, Berkshire will actually continue to buy back its shares in 2021 too, which in my opinion is just a way for Warren Buffett to outline that Berkshire stock is a buy for him at this price. I could be totally wrong about this, but this is what conclusion I draw. This is the conclusion I draw from his actions and outlining his thought process and knowing his philosophy on share buybacks. Let's talk about bonds now. Bonds have been the headline for the past couple of weeks, with the 10-year Treasury leaping to a 12-month high, causing the market to have a couple of red days and the rotation from the tech stocks. Nothing major, nothing dramatic, just media being a drama queen as always. However, here's Buffett's take on the current bond environment, and I will lead with his thoughts from the letter. Bonds are not the place to be these days. Can you believe that the income recently available for a 10-year US Treasury bond, the yield was 9% at year end, had fallen 94% from the 16% yield available in September 1981? In certain large and important countries such as Germany and Japan, investors earn a negative return on trillions of dollars of sovereign debt. Fixed income investors worldwide, whether pension funds, insurance companies, or retirees, face a bleak future. Well, here's the takeaway for me. I will stay away from bonds. The yield produced by those bonds in the current environment is lower than the inflation itself, guaranteeing a loss on the yield of those bonds. For that reason, it will probably be way better to just focus on buying wonderful businesses that are growing their revenues above the current dollar debasement rate. Some of the businesses that fit this criteria and that are currently trading at a premium but that are still growing their revenues massively are Amazon, Apple, Facebook, and Google. I mean, even at the current valuation, they will probably do way better than bonds over the next 3 to 5 years, or at least that's what I believe based on the current environment and the information that I have available right now. In the end, here's Buffett's unwavering conclusion: never bet against America. Alright everyone, thank you so much for watching this video. If you reached this part of the video, you are the real MVPs. I want to thank you so much. Let me know your takeaways in the comments below, and if you want to watch another value investing video, it's going to be on the screen in a few moments. But until next time, take care, have a wonderful day, and don't forget that you are amazing.